Hey, no camera today. I was really sick this week and I'm going to spare you guys that. Let's talk about covered calls. Hey everybody, this is Pookie's Revenge. We're back with another episode of the 5-year $500 Rags to Riches series. And today, as I said, I don't want to put you guys through it. There's no camera today. I'm not feeling too hot. I'm about 85% there though, so we're getting there. But I also wanted to make a video to show you guys, rain, sleet, snow, or hail. That may be trademarked already, whatever. I try not to take too much time off from this. So anyway, let's get to it. So covered calls are one of the strategies that I'm going to be incorporating into this portfolio, and we're kind of getting up to that level where I can start doing it. So I want to get it kind of mapped out on everyone's radar so everyone can understand it. But first, really quick, let's just kind of blast through the portfolio just to kind of summarize where we're at. So VSIG and NRSN were high potency catalysts. They had a little pop and a drop. They're low float. I just decided to hold these because I did like the catalysts on both of those. I already locked in profits on MTech, and I can't remember the third one. I traded it yesterday. I got a quick like 50% profit and then sold about all but 3 shares and then it sold off. So nothing too major. I'm just trading with little small positions or like $25 positions. And again, the purpose of this isn't to do anything that the normal trader can't do. And the rule here is that we don't want speculation to be the make or break. So I'm still doing a little bit of speculation just to show you guys kind of the pluses and minuses, but it's not to control the portfolio with just speculation. So if you can't speculate, that's okay. All right, so just kind of moving through the positions here. Main has been pushing up pretty nicely the last few days, last week or so. Pretty good bounce off this little support level, which is right where my cost basis is. It's a nice support line. And then we got O, obviously, Schwab. We got Johnson & Johnson. That also pushed up today. Now, the market overall kind of pushed up pretty strong with, Nasdaq was up. Futures are up pretty strong, and then Nvidia earnings obviously running triple digits, almost up to $800, was pretty significant. So kind of put a lot of euphoria in the market. So I don't expect all this to last, but these are pretty stable positions that have shown some pretty good moves today. So Clip obviously is in this little channel here. I'm not too worried about the speculation on Clip and Tesla, obviously. I don't really care what happens on the chart. Tesla does have a split coming up, so that'll be interesting to watch that. Basically, they're just going to take all the shares that I have, they're going to cut that number in half, and they're going to double the share price. So that will also double the dividend payout because it's based on share price, but it'll reduce the quantity of those payouts. So overall, the market price value shouldn't be adjusted, but there might be sell-off and things like that, just so everyone's aware. But again, I don't care about the share price too much. And then Ladder, obviously, is just my long-term growth stock that just going to give that one plenty of time. All right, and then I got my Neo Leap. That kind of pulled down a little bit, so I'm not too worried about that. And I got the 2 speculation positions here. And then I traded SPX again today for my monthly loss on that one as a $35 trade. I put a $60 trade on the line, racked in profit, and then I took about a $30 loss on that. So I'm still net positive on that series of trades, but now I have an SPX tax advantage that I can use on my taxes. It goes towards the realized losses that I can claim. So it's all part of the plan. I'm super happy about just being able to show you guys this stuff from beginning to end. So part of that is going to be covered calls. So this might look a little bit complicated, and if it is, I apologize, but I just want to walk through, for those who are familiar with them, kind of the advantages, disadvantages, and potential outcomes. So for anyone who's not familiar with a covered call, that just means that when you have 100 shares of a stock, 100 or more, I should say, you can do what's called a covered call. So you can write a contract, which basically just represents someone else's right to buy your shares if it's a call. And then you can take that contract and sell it to someone else. So they pay you money in exchange for the right to buy your shares. Okay, and it might be a little bit complicated with the wording and trying to get your brain wrapped around it. So we're going to walk through one just to kind of illustrate how it all works. So let's just say that I start with 100 shares. The first thing I want to do is buy 100 shares of a ticker that I like. Okay, I don't recommend ever doing this with a stock that you hate or that you can't justify owning. So let's just zoom in and we'll go through these blocks one at a time, and I'll try to make this as short as possible. I'm already about 5 minutes in and I'm rambling, so you guys know how I get. So we pick a stock that we like. Ideally, it would be some sort of growth position. If it offers a dividend, that's even better because it'll help reduce the cost basis faster, but it doesn't have to be that way. Just pick a nice solid ticker that you like that you can justify. This strategy is ideal for flat to mild bearish markets. You don't want drastic sell-off and you don't want the price to blast. It's not the end of the world either way, but you just want to be careful about where the price kind of hangs out in a range. So once you buy 100 shares, the initial deficit in your portfolio at that point is going to be the cash deficit. So you've bought 100 shares, so you've paid some amount of money. Let's say, just as an example, $10 per share, and you've acquired 100 shares in exchange for those $10 per share. So you paid $1,000, you get 100 shares, okay? At the end of the day, right now, it's just like any normal trade. You just bought 100 shares and that's it. Price will go up, price will go down, you can sell. Doesn't matter, right? But since we're options interested, we can look at the options chain. And the option chain is just a set of data that represents the pool of contracts that have been written against a stock. So this is ladder, for example. There's no volume on these. They're 22-day contracts. You don't have to know about all that stuff, but I just wanted to walk you guys through what the overall process is. So if there isn't a healthy option chain like ladder, the option chain sucks. So I'd never do a covered call on the stock. Therefore, covered calls are not applicable here. I would move to the next ticker that I like. And you ideally want to do this before you buy 100 shares, but it's always good just to see if the stocks you already own are eligible. So if yes, then we can sell a covered call. Now, it doesn't mean you have to or that you should every single time, but it means that we have the opportunity to. So if we agree with the covered call, we looked at the contract and we said, this is the premium that I want to collect up front. I want to sell my right to buy shares to someone else for a fee, and then they pay me that fee and I keep that fee no matter what happens. I'll sell a covered call. That's the premium that we collect. It's the price of the contract that the buyer has paid you in exchange for your right, or their right, I'm sorry, to then buy your shares if they want to, okay? When they buy it, okay, they pay you the premium, you keep that. The contract value will then go up or down based on where the price goes. So if the price goes flat, the contract value will go down because of time decay. If the price goes down, the value of the contract will go down because it's a call. They want the price to go up. So in either of those scenarios, the contract will not gain value. It'll lose value over time. If the price goes up, the contract can gain value, but it has to outperform the time decay. So the odds are in your favor in most cases, unless the price is pretty aggressively pushing to the upside, okay? That's why you want to do this in a mild to bearish market. If the value of the contract doesn't go up and the contract expires worthless, right, because the contract has an expiration date, so if it doesn't break into positive territory by the time the contract expires, you just keep the entire premium and nothing happens. You keep your shares, the contract goes away, and you've just collected their premium. They've paid you like a fool, and they never got to use their right to buy your shares. So you keep your shares and you keep the premium. That's the ideal scenario, and that's kind of where we want to get the most iterations of this process, because that's the most profitable scenario. Okay, but that's rarely how things work in the real world. So let's look at what happens if the contract value goes up. So say that you've bought the stock at $10 and you've sold a $12 contract and you've received a 50-cent or $50 premium, right? The price maybe goes up to $12. Okay, and maybe it's at or near the point where it can outperform the time decay, but it hasn't quite breached into positive territory. Let's say it just can't beat that time decay. It can't beat the erosion of theta. All right. The contract will expire worthless, and again, same scenario. So even if it goes up, it still has to outperform that decay, and if it can't do that, you make that net profit, and you just keep your shares and the premium. Okay? If you're at risk of being assigned, so if it's gone up more than enough to outperform that time decay, then you're at risk of being assigned. So that means that someone can exercise that right to buy your shares. Okay? If that happens, you still have an agreement in place for them to buy your 100 shares per contract at the strike price. So if you bought your shares at $10, okay, and they paid you $50 for that contract, your cost basis is $9.50 per share in this case, okay? If they assign the contract and the strike price on that contract was $12, that means that they're going to pay you $12 per share times 100 shares, which means that your net profit on this transaction so far will be $2.50 per share, or $250 since there's 100 shares. So when this assignment happens, they'll buy your 100 shares, so they leave your portfolio, and then the buyer of the contract pays you $250, $200 for the share price difference, right, from your cost basis to the strike price, plus the premium you've already collected. Now this point is where a lot of people tend to mess up and they include the premium they collected twice. That's not what you should do. You should keep these transactions separate. So when they pay you the premium, you should log that separately. And then when they pay you the cost basis, that is separate. So you're collecting this piece separately from this piece. But a lot of people include the premium twice because they say, okay, I've collected $50 for the premium, and then I also collected the difference in strike price and my cost basis rather than the strike price to what I've paid for the shares, which is $10, not $9.50. So that might be a little complicated, and I can break that down a little more in detail, but just understand there are two different elements there. So when they buy the contract, you get the premium. Regardless of what happens, it can go up, you can get assigned, it can expire worthless, whatever. That money's in your account no matter what. If you get assigned, they still have to buy the shares at the strike price if they want to assign the contract. So if you bought them at $10, the strike price is $12, that's $2 per share times 100, $200 profit from the shares alone, in addition to the premium for the contract itself. Okay, so I just want to emphasize the difference between those two. At that point, you will no longer have your 100 shares. You'll have an extra $250 in cash, and you can start over by buying another 100 shares if you want. Repeat the process, or you can move on. Okay, let's rewind a little bit here, and we say, is the contract currently at risk of being assigned, right? We've kind of rewound before the assignment happened. If it is at risk, so if it's in positive territory and you haven't been assigned yet, what you can do is you can buy that contract back for a partial profit before your assignment happens. So in that case, you'd have to just buy the same contract back, which is the potential risk there. So obviously, since there's defined outcomes here, we have defined parameters for the trades, right? So if you have to buy the contract back, you're losing a part of that premium you've collected in order to buy it back. And since the strike price is the agreed upon transaction price, that means that if the price runs up, $8, you're still selling at the strike price, so your profits are limited, right? And that's kind of the only real drawback to this strategy, is that the profits are limited if you're doing it on a stable stock that you want to hold. Okay, so let's say you buy the contract back, you kind of take that hit, you can immediately sell another covered call. Okay, and just repeat the process. You keep a portion of that premium anyway, and then when you sell the next covered call, you get more premium. So it works out pretty nice. So let's just walk through a couple scenarios here. So you buy 100 shares at $10. Let me just zoom out here. All right, buy 100 shares, $10 a piece. That's $1,000. There's a healthy option chain. You sell a covered call for 50 cents. You pay $50 for that, or you get paid 50. I'm sorry. That brings your cost basis per share down to $9.50. So at this point, you've got 100 shares in your portfolio, and you've also got $50 cash from the contract being sold. Okay. If nothing happens, the contract expires worthless, you keep the $50, you move on to the next one. Okay, and let's just assume you sold a $12 contract. Okay, you can repeat that as many times as you want, and the more you do it, and the more successfully you can do it, the lower your cost basis for those 100 shares becomes. And then what happens is, over time, you're opening up the range where you can sell those strike prices. So if you paid $10 per share, okay, and you reduced your cost basis down to let's say $7, okay? That puts you in the range where you can sell covered calls at $8 or $9, even though you paid $10, and you can get assigned on the $8 or $9 strike price and still make a profit because you've lowered your cost basis below the strike price that you're agreeing to, okay? And if, let's say, there's a drastic move off something like earnings, for example, let's say you've paid $10 and let's say you haven't been able to reduce your cost basis, let's say it's your first iteration. So you sell a covered call and the share price is $5, you can still sell a $6 or $7 contract, a strike price. You just have to be more cognizant of whether or not it's likely to be assigned, because if it is, you're going to have to buy that contract back. Otherwise, you pay $10, you're agreeing to sell those shares to someone else for $6 or $7. That's a big hit that you're going to take if you don't buy that contract back. So you can still sell covered calls if the price falls off, but you have to be careful to buy it back before you get assigned. Otherwise, you're going to take a loss on those shares. Okay. So there's a lot of people that believe that, if you buy your 100 shares, you can't sell covered calls until the price is above your cost basis. That's not true. You just have to be very, very careful about not getting assigned. Otherwise, you will take a loss. Okay. So I hope that explains this pretty clearly. If not, I can always make more descriptive videos, and I can map out the examples with the dollar amounts and number of shares along the way if you guys want. Just let me know, but I am going to end this recording here because it's about 15 minutes and I'm not feeling well, so I just don't want to go too far. So I will catch you guys tomorrow. I live trade in the morning in the PB section, so I will see you guys there, and everyone have a good night.